Good morning and welcome to GrainTV for July 20th, 2012. To my left is Logan and I'm Brock Shimbino. Weather forecast remains the same for the weekend. Hot, dry weather across much of the Midwest. Not a lot of new fundamental news to drive the futures one way or the other, so let's turn our attention to the cash market as we see some massive changes going on with basis levels across the country. The corn index for the country was actually down 8 cents nationally. River terminals leading to the downside, down 15 cents this week. Ethanol plants falling along, down 7 cents this week. Logan, I have to think this is kind of concerning because it looks like we're having a slowdown in demand, but also I believe that basis is not keeping up with what the futures are doing. We've seen a sharp rally over the last couple of weeks.
Right, absolutely. Well, if we turn attention here to soybeans, kind of a different story here, actually up 4 cents on the week per bushel there for average spot soybean basis. As you can see here, South Dakota, Iowa, Nebraska, and Minnesota were all the leaders here to the upside. One good thing, in terms of we've been talking about demand destruction a lot here on GrainTV recently, one good thing to see is that we did have soybean plants, those crushing facilities, actually strengthened basis by 12 cents here over the week. River terminals were down 6 cents here, kind of in light of a rising barge rate situation here. So we'll have to keep an eye on that. But that's kind of what we're seeing right now for spot corn and soybean basis. Let's hop over to fire tips, see how the trade is panning out here this morning.
As you can see here, old crop corn is up 4 1/4 cents, new crop is up 15 1/4, old crop beans up 23 1/2, new crop beans up 33 1/2, wheat in Chicago off 2 1/2 cents, and Kansas City wheat off 1 3/4 cents as well.
Yeah, here. Well, Brock, right now this December corn contract is leading over that old crop corn right now, and we wanted to take a quick moment and kind of look at the spread that we're seeing right now between December 13 corn and December 12. As you can see here from this chart, the vertical axis is basically showing the premium that D's 12 corn is carrying over D's 13 in terms of cents. So as you can see here, just about a month ago, these two contracts are trading even money, as you can see indicated by the 0 here on the vertical axis. And as this weather premium has really gotten built in to that D's 12 contract, yields have been dropping dramatically here. We're now carrying a 172 cent premium D's 12 over D's 13 right now. Market's really indicating to producers to be selling corn right off the combine here. No carry in this market by any means.
Yeah, we've had a lot of questions on how you could take advantage of this.
Right.
Several different ways you could. You could actually be doing an HTA or sell it short the futures on the board. That's going to kind of put a lot of risk into your marketing plan.
Right.
So that's not something that you'd be looking at if you didn't want to deal with margin calls for about a year or so. Another strategy you could do is you could be looking at doing some sort of put strategy. Keep in mind though, you're going to be paying for a lot on time premium if you're going to hold that out until December 13th.
Right, absolutely. A lot of time, a lot of premium in that in terms of time value here right now. If you have any questions about your marketing strategy, you need to remove some risk here for that 2013 crop, give us a call here at the office, 877-472-4607. You can bounce your ideas off us. I think that kind of wraps up our show here for Friday morning, Brock. Thanks a lot for joining us. Have a great weekend.